Entering 2026, China was stockpiling crude oil at the fastest rate in its history, adding over 1 million barrels a day to its immense inventories. Then, the Strait of Hormuz disruption hit. The world's biggest oil buyer abruptly stopped filling its tanks. But while the flow of crude oil stalled due to spiking prices, the massive physical infrastructure build-out powering that storage network never stopped. For B2B energy suppliers, confusing a temporary pause in oil purchasing with a halt in spike capacity planning is a critical commercial error. This chart shows China's sustained accumulation of crude reserves. Through 2025, they added 1.1 million barrels a day. By early 2026, that accelerated to 1.24 million. That aggressive purchasing pushed combined reserves to an estimated 1.4 billion barrels. Beijing ordered this massive accumulation to build a physical buffer, securing maximum leverage to insulate the country from the next market shock. In late February, the Hormuz closure sent Brent crude spiking past $100. Instead of chasing cargoes, China slashed imports to 7.8 million barrels a day. That single decision accounted for 74% of the global crude trade drop. By consuming from its own 1.4 billion barrel storage instead of buying, China entirely absorbed its own demand shock. The reserve worked exactly as engineered. The commercial reality splits the market in two. The fill rate fluctuates with oil prices, but the capacity program runs strictly on state planning cycles. State energy companies are currently building at least 169 million barrels of new storage capacity across 11 active sites. Those sites require civil works, pipeline tie-ins, metering, fire suppression, and marine logistics. None of those contracts stopped when the oil trade paused. Forecasters project that as soon as global prices normalize, China will resume filling those empty tanks at up to 1 million barrels a day. If you supply this infrastructure, you are selling into the long-term build-out program, not the daily spot price of crude. The liquid commodity may sit still when prices spike, but the physical market building the tanks remains wide open. For deep demand intelligence and engineered revenue strategies, visit Project 54.